It's Friday, March 17th. What a week it's been in the investment world. We've seen a huge change in short-term interest rates as nervous investors have shifted money from stocks to the safe haven of short-term government bonds. It was just a week ago I was talking about how short-term interest rates kind of across the board were in excess of 5%. Now some of those same bonds that I was referencing are down in the threes. But what's really remarkable is brokered CD rates are hanging in there. This looks like an opportunity to me. That's what I want to share with you today. Let's get into it. Now, just for reference, I want to show you what transpired in the interest rate market over the last 10 days or so because it was a huge move. So we're looking at a year-to-date chart here. This is the 1 and 2 year US government bond. And again, they briefly surpassed that 5% level. This was a huge deal in the investment world because we hadn't seen yields at these levels for something like 15 years. But then what happened was all of a sudden we had these troubles in the banking sector, specifically beginning with this Silicon Valley Bank out on the West Coast. And long story short, this spooked the markets. It feels like some of the issues we had back during the global financial crisis in 2008. Ironically, those troubles really started coming to light in March of that year. And long story short, again, this spooked the markets, and we've seen a big shift from riskier assets like stocks into more safe haven assets like short-term government bonds. And when you see that happen, what it does is it pushes short-term interest rates down. So we've had this huge move, but what I want to show you in a second here, what's interesting is the market for brokered CDs, the yields were hanging in there. And I bought a couple for myself in excess of 5% in recent days. We're starting to see it adjust, which I'll show you in a second, but I think there still is an opportunity if you're looking to purchase CDs in that 5% range. Now, I'm going to show you where rates are in Fidelity's fixed income platform. To be clear, today is March 17th. It's Friday, late in the afternoon. So these numbers are changing all the time. So by the time you watch this, they're going to be different. But nonetheless, I'm doing the best I can to get this out in a relatively timely fashion. If you want an entire how-to video and how to buy brokered CDs, I'll try to link that up here if you're watching on YouTube. If you're watching on one of the other platforms, I'll try to put it in the comment section. I did an entire other video on that, again, to step-by-step how you purchase brokered CDs through Fidelity. Now, real quickly, to see where rates are, if you have a Fidelity retail account, what you do is, if you're on the home screen, you go to this drop-down, News and Research, come down here to Fixed Income, Bonds, and CDs. Now, once you click that button, you're going to find yourself in Fidelity's fixed income platform. If you scroll down here, you can see where rates are. This is what I always am looking at. I'm always comparing where brokered CDs are in contrast to US government bonds or treasuries. Because theoretically, these things have the same credit risk. If you're with CDs, if you're within the FDIC limits, obviously you're backed by FDIC, which of course is the federal government, and likewise treasuries are ultimately backed by the full faith and taxing power of the US. So theoretically, these things should be very close. But occasionally, a big gap will open up, and that's exactly what we saw this last week. As investors dumped into treasuries, they pushed rates down, and you can see that in this table. But brokered CD rates basically didn't move. Now there's like a 1% spread across these various maturities. And this is the opportunity or the interesting scenario that I wanted to point out to you. Now, one thing to remember is if short-term interest rates in the Treasury market specifically, if they stay at these lower levels, and there's a great debate about that right now, of course, the Federal Reserve's meeting within the next week to decide on what they're going to do with short-term rates. But my point here is if rates stay low, the rates on brokered CDs are going to follow. And why is that? Again, it's because these are very comparable asset classes. And when you get a divergence in price like this, at some point you're going to see dollars shift. I mean, people that are investing in treasuries are going to start shifting money into CDs because they can get a higher rate, and that will bring these two back into alignment. So this is why I think there could be an opportunity here. Of course, it's highly dependent on what happens with treasuries. Now, the last thing I want to mention here is I've personally been buying a little bit longer maturity CDs as part of a broader CD portfolio. So, for instance, this week I bought a 2-year and a 3-year, both which were yielding in excess of 5%. And why did I do that? Well, I did that because I think there's a pretty good chance that we're going to see an economic slowdown over the course of the next 6 to 12 months. And historically, when we have a recession, which you can see in all these gray shaded areas, these all represent recessionary periods, what happens to short-term interest rates? Well, as you can see in the chart, they come crashing down. We're graphing out the 1-year and the 2-year Treasury. And why is that? Well, it's for a couple reasons. When you're in a recessionary period, people tend to clam up. They want to avoid risk, so money tends to shift from riskier assets into safer assets, and like we talked about earlier, that pushes rates down. Additionally, one of the Federal Reserve's, their primary tools for battling an economic slowdown is controlling short-term interest rates. So that also is a force that tends to push short-term rates down. My point is, if you think rates are going to be lower 6 months or a year from now, well, you would want to lock in a longer rate today. So that's why, again, I personally have bought some longer maturities. We've already seen we saw Treasuries, which I mentioned right at the very beginning. Briefly, we're at 5. There's a lot of people right now that I'm sure are thinking, man, I wish I would have bought a bunch of 2-year Treasuries at 5%, because now they're hanging in the 3s, and there's great debate as to whether or not we're going to see them crawl back up or not. But anyway, I'm being too long-winded here. My point is, if you think there's a shot that interest rates are going to fall, if we're going to see some economic weakness, you might find yourself patting yourself on the back or being very happy that you bought some longer-term issues. Now, last but not least, on the end screen here, if you're watching on YouTube, I'm going to link to a video titled, "Can I Lose Money on Brokered CDs or Government Bonds?" It's important to watch if you've never purchased one of these securities. Okay, because the answer is, well, it depends. If you hold till maturity, you're good. But if you want to sell sometime in between, you can find yourself in trouble, much like the Silicon Valley Bank. So if you're watching on one of the other platforms like Facebook or LinkedIn, I'll make sure to drop that in the comment section below. Look, as always, thanks for watching, and I hope we'll see you on the next one.